Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing SoFi stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. SoFi is an online personal finance company. The company started out just providing student loan refinancing options. It currently conducts business through three segments: lending, technology platform, and financial services. The company has expanded its lending strategy to offer home loans, personal loans, and credit cards. It has 3 million members, which is double from the number of members at this time period last year. It has partnered with several third-party insurance companies such as Lemonade in order to offer life insurance, auto insurance, homeowners insurance, and renters insurance. If you're looking to invest in the stock market, then SoFi provides that service, offering no commission and no fee trades on stocks and ETFs. The company formally applied for a national bank charter in July of 2020. The company acquired community bank Golden Pacific Bancorp to try to help advance those efforts. It currently underwrites its loans using third-party banks, but a charter would allow SoFi to fully operate as a bank, using customer deposits to fund its loans. Aside from regulatory changes, a lower cost of capital would be the primary benefit for SoFi. If they did get a national bank charter, it would greatly improve their profitability. Its management estimates that a charter could improve the company's EBITDA by an incremental $1 billion through 2025. In February of 2019, SoFi partnered with Coinbase to offer cryptocurrency trading. SoFi offers trading of Bitcoin, Ethereum, Litecoin, and more than 17 other crypto assets. Although cryptocurrency transactions are one of SoFi's only products that have fees, currently set at a 1.25% markup. So you can see this is an all-in-one service. You can do your banking, investing, you can pay for your school loans, your mortgage loan, your credit cards. It's all in one app. SoFi was funded by a SPAC. A special purpose acquisition company is formed to raise money through an IPO, then acquire a private business to help them go public. This is also known as a reverse merger or reverse takeover. In June of 2021, the merger was completed, and SoFi received $2.4 billion in cash proceeds. The SPAC that acquired SoFi was Social Capital. The company is headquartered in San Francisco, California, and was founded in 2011. It trades on the Nasdaq, Deutsche Börse, Mexican Bolsa. Let's get started with the model. This is a large cap company, 13 billion market cap. They're trading at $16 a share, and they have 800 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. It looks odd that they had so much free cash flow in 2018, much higher than their revenue. But after 2018, they had negative free cash flow. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that's negative every year. Revenue is a sales for the company, and that grows a lot from 269 million to 870 million. This is the company's income statement. The top line is the revenue, the sales. Below that is their expenses, then their pre-tax income, their taxes, and the bottom line of the income statement is their net income, which is negative every year. This is the income statement from their 10Q, which gives us a lot more information. This shows us the first 9 months of 2020, the first 9 months of 2021, the third quarter of 2020, and the third quarter of 2021. Their revenue for the third quarter was 272 million, 93 million from interest income, 21 million of interest expenses, so that's a net interest income of 72 million. They received 200 million of non-interest income, so it's a net revenue of 272 million. In the interest income section, 89 million was from loans, 3 million from securitizations. Their revenue is higher from the fees they charge. 142 million for loan origination fees, 50 million from their technology platform. Here's a breakdown of their third quarter revenue, the 272 million. So their lending business is their bread and butter. That was 210 million of revenue. The technology platform was $50 million and financial services of $13 million. The most income they receive is $142 million from the fees on loan origination. This includes student loans, home loans, and personal loans. Their revenue are the fees during the origination process. And sometimes they service those loans or they sell them out, which is also known as securitization. They receive $50 million from their technology platform. Their business-to-business technology platform is Galileo. They acquired Galileo in May 2020. So other businesses would use their platform to conduct their financial operations. SoFi takes a fee for integrating those businesses onto Galileo. And that appears to be an upfront fee that takes care of all future services. Securitizations of $3 million, and the non-interest income was negative $4.5 million from securitizations. I worked in securitizations for many years in New York City. If someone takes a loan through SoFi, instead of SoFi servicing the loan, meaning they have to wait for the person to pay their principal and interest payments each month, which of course is risky because not everybody pays their principal and interest payments. So what they do is they sell those loans in a package. It's called a securitization. They may wrap up 100 loans into a securitization and issue a bond, and the loans back the bond. So as those 100 people pay their principal and interest payments, those funds come in and pay the bondholders. So the securitization is a sale of the loans, but they retain certain residual interests in the securitization structure, and they have to mark to market their residual value. They mention that here, we measure these investments at fair value on a recurring basis. Gains and losses related to our securitization investments are reported within non-interest income. Remember we saw that negative in non-interest income? We determine the fair value of our investments using a discounted cash flow methodology, while also considering market data as it becomes available. We classify the investments at level 3, due to the reliance on significant unobservable valuation inputs. We classify asset-backed bonds at level 2, due to the use of quoted prices for similar assets in the market that are not active, as well as certain factors specific to us. They use IRLC to mark-to-market their derivative contracts. IRLC, interest rate lock commitments. And it talks about level 1, level 2, and level 3. This is why I hate valuing financial stocks. Stuff like this. It's just so confusing and complex. They make it so difficult to understand. In the third quarter, their expenses were $74 million of technology and product development, $115 million of marketing, $70 million in cost of operations, and $40 million in G&A. So they had a net loss of $30 million. Last year was a net loss of $43 million. In the trailing 9 months, it was a net loss of $373 million. This is the statement of cash flows. The top line is operating cash flow. That's how much cash the company loses from its operational business. So you could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. They somehow had a $1 billion gain in operating cash flow in 2018. They just recently went public, so I don't have the detail for their 2018 financials. It was negative in the other years. They do spend a decent amount on CapEx due to the technology fees, $45 million in the trailing 12 months. Operating cash flow minus CapEx gives you your free cash flow. Since they usually have negative free cash flow, they fund their business with equity and debt. They issued over $900 million of equity in 2019 and 2020. They did buy back a lot of capital stock in the trailing 12 months, over $300 million. And they're always issuing and paying down debt because they have to fund those loans. So it just makes it really confusing. There's so much going on. I'm trying to sift through all the data and explain it concisely. This is their operating cash flows from their 10Q. This shows us the first 9 months of 2020 versus the first 9 months of 2021. And the way you calculate operating cash flow, you start with your net loss. Then you have to add or subtract the non-cash items on the income statement, then adjust for changes in working capital. We start with a net loss of $370 million. We have to add back depreciation, stock-based compensation. It looks like they passed to a loss on their income statement for their warrants, so we have to add that back here on the statement of cash flows. They had a cash outflow of $9.4 billion from originating loans. and a cash inflow of $9.3 billion from the sale of those loans. So it looks like they're not servicing the loans. They're probably just securitizing all of them. Because when you provide a loan to somebody, not only do you have to wait for the principal and interest to come in, all your funds are tied up into those loans, so you don't have extra money to provide more loans. So that's why securitizing or selling the loans out to another bank is a common thing. Even though they reported an accounting loss of $370 million, they actually lost $113 million of cash flow. Last year was an accounting loss of $141 million, but a cash outflow of nearly $500 million. Let's look at their investing cash flows. They spent $38 million on PP&E. I think most of their PP&E is software for their products. They purchased $200 million of securities. They sold $100 million of securities. And they sold $200 million of securitized investments. In their investing section, they had a cash inflow of $80 million. Last year was a cash inflow of $188 million. Let's look at their cash flow from financing section. This shows us the first 9 months of 2020 versus the first 9 months of 2021. They received $6 billion from issuing debt. They repaid $8.4 billion of debt. They paid $37 million of taxes on their stock-based compensation. They redeemed $282 million of preferred stock. They raised $2 billion from a PIPE investment. That stands for private investment in a public entity. Instead of raising equity in the capital markets, they just went to a company and sold them a bunch of stock at a discount. In their financing section, they had a cash outflow of $430 million. Last year was a cash inflow of $400 million. Let's look at their equity as of their 9/30 balance sheet. They have $4.2 billion of equity. They raised $320 million from selling preferred stock. Preferred stock is a hybrid between equity and debt. You get some capital appreciation similar to common stock, and you get a guaranteed dividend payment similar to bonds, which get a guaranteed interest payment. So it sits above common stock on a capital structure. In the event of a default, preferred stock is paid before common stock, but bonds are paid before preferred stock. But companies don't get a tax deduction when they give dividends to preferred shareholders. They do get a tax deduction when they give interest to bondholders. But in SoFi's case, it doesn't really matter because they're not profitable, so they're not really paying much in taxes anyway. They raised $5.3 billion from selling their business, and they lost $1 billion from running their business. Let's look at the capital structure. They have $4.2 billion of equity, $3 billion of debt. They're 58% equity, 42% debt. And their WACC is 8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $20 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $15 billion. We divide that by 800 million shares. And we get a calculated stock price of $19. They're trading at $16, so they're trading at a 15% discount. It's a buy according to the model. Their revenue is projected to increase 28.1%. So I increased their revenue 28.1% for the next 4 years. That's how I got their future revenue estimates. To get their future free cash flows, I need to see what percent of their revenue they convert to free cash flow. Since they mainly have negative free cash flow, I looked at the industry average. The average company in their industry converts 54% of their revenue into free cash flow. So I multiplied their 2024 revenue by 54%. That's how I got their future free cash flows for that year. And I just assumed they would have negative free cash flow before then. So it is really difficult to value this company at this point. It could go a lot of different ways. Simply, Wall Street values the company just using their price to book ratio, which is a common way to value banks and financial institutions. And they have a 3.0 price to book. The lower the better. If you see a price to book below 1, that could be a great value for a bank. 8 analysts priced this stock, and the average price target is $24. The low is $19, the high is $30. A good way to value any company pretty easily is look at how many customers they have. And they're doing a really good job at growing their customer base. They're already up to 3 million. And the year-over-year growth is about 100%. If they can maintain this pace, they can easily be a $100 billion market cap company. This is where the stock has been trading historically. When a SPAC starts out, it's $10. When the SPAC announces they have an acquisition target, even before the actual acquisition, the stock price usually jumps way up, and then there's usually a big sell-off and it comes back down. A lot of SPACs have come down below the initial $10 price. This has not. It did peak about $28, $29, but I think there's some major upside with this stock. If this wasn't a SPAC, I'd be more bullish on it, but for some reason these days it seems like SPACs have a black cloud hanging over them. Most of them seem to really struggle. The stock has gone up 30%, the same as the S&P 500. The low was 12, the high is 28. And the stock is trading below its 50-day and 200-day moving average. This is a really popular stock. Over 30 million shares are traded each day. 29% of the shares are held by institutions and 7% are shorted. The company employs 2,000 people. If you invested $10,000 when this company started trading, you'd have $13,000 today. That's a 30% return. There's been lots of insider buying and selling, mostly selling. When a SPAC goes public, the company or the people who own the SPAC before it went public want to cash in, so they usually sell their stock. Within the last 3 months, 45 million shares have been sold. In 3 to 6 months, 1.1 million shares. The massive Japanese company SoftBank sold 22 million shares. Clay Wilkes sold 10 million shares. Clay is a CEO and founder of Galileo. SoFi acquired Galileo in 2020. The general public owns 46% of the company, institutions 31%, public companies own 12% of them, and individual insiders own 11.5%. SoftBank is the biggest shareholder at 12%, 93 million shares valued at $1.5 billion. Then Vanguard, Clay Wilkes, T. Rowe Price, and Silver Lake. Instead of giving Clay Wilkes money when they acquired Galileo, they gave him stock in SoFi. It may have been a combination of stock and cash, but it's better to give stock so you can retain the cash. But you can't blame Clay for selling his stock, because I'm sure he worked really hard building Galileo, and he wants to cash in on his time and investment. Let's look at their financial ratios. We can't look at the PE since they have negative net income. They have a high price to sales of 14.5. But when you look at a financial institution or a bank, you want to go with the price to book ratio. That's what most people look at to figure out if the stock is over or undervalued. And they're at 3.0, which seems pretty good, but I'm going to compare it to companies in the same industry in a little bit. Price to book is stock price over book value per share. So investors are paying $3 for $1 book value. The way you calculate book value per share, it's equity over shares outstanding. Equity is on the balance sheet. It's assets minus liabilities. They have $4.2 billion of equity, $2.9 billion of tangible equity. Even better than price to book value is tangible price to book value, since intangible assets are kind of worthless, especially goodwill. I'll show you all of this later when we compare this company to other companies in their industry. Here's a list of the company's assets according to its balance sheet. $500 million of cash, $300 million of restricted cash. Restricted cash is cash that's set aside for a specific purpose. $200 million of investments, $5 billion of loans. So $4.9 billion is the total balance of all the loans outstanding minus the expected credit losses. $164 million of servicing rights, so they capitalize some of their servicing fees. $392 million of securitizations. $20 million of equity method investments. When a company owns between 20% to 50% of another company, they usually use equity method accounting. So the value of the companies they own using equity method accounting is $20 million. If they own more than 50% of another company, they do not use equity method accounting. They just consolidate all of that company's financials onto theirs. $100 million of property, equipment, and software. $900 million of goodwill. Goodwill is the premium you pay when you acquire another company. So it's the acquisition price minus net assets. $300 million of other intangibles, $117 million of operating leases, and $174 million of other. So they have $8.1 billion of assets. They have $325 million of accounts payable. This is how much they owe other companies for purchasing stuff on credit. $140 million of operating lease liabilities. This is the future rent payments on their properties discounted back to today's dollars. $2.8 billion of debt, $103 million of residual interests, this is classified as debt, and $175 million of warrant liabilities. So when they issue warrants, they have to carry that on a balance sheet until the warrants are exercised. The best way to look at ratios is to compare them to companies in the same industry. There are 63 companies in the same industry as SoFi. SoFi has a much better debt to equity ratio than average. They don't pay a dividend. The average company has $8.9 billion of free cash flow. They're negative. They're the 12th largest company in terms of market cap. The average market cap is $23 billion, they're $13 billion. And you want to look at price to book when valuing a company in this industry. And they are better than average at 3.0, average is 4.0. Even better than price to book is tangible price to book, and they're worse than average. The average is 3.3, they're at 4. The reason it says NA for some companies is because they have negative price to book, and you can't have a negative price to book. Let me show you why it's really important to understand the assets, especially if they have lots of intangible assets. If I told you one company has $8 billion of equity and another company has $4 billion of equity, you might think the $8 billion equity company is much better. It's twice as good. And they have $10 billion of assets, that's all goodwill. And you can't sell goodwill. It's not really worth anything. And they have $2 billion of long-term debt. So in a sense, they don't have any assets. They just have $2 billion of debt. And if you look at the other company, they have $5 billion of cash, which is the best asset, and $1 billion of long-term debt. So this company has pretty much $4 billion of cash, which is much better than example one. They just have $2 billion of debt. So that's why it's important to understand what the assets are. And not all tangible assets are equal. Cash is obviously the best asset, but you may have tons of equipment that may not be worth that much to other people besides you. So if you need to liquidate, you might not be able to get that much for that equipment. We can't look at their price to free cash flow since they have negative free cash flow. Their price to sales is much worse than average. They're not bringing in much revenue at this point, but they're still growing and growing really fast. To summarize, I have them trading at a 15% discount. But this company may grow a ton because they make banking so easy. And a lot of people these days don't want to go to a bank, or they don't want to sit on the phone with a bank trying to get things done. It's so much easier going to one place or one website rather than 5 different websites or 5 different companies. One company with your credit card, one company with your school loan, one company with your home loan. So they do this all in one. But of course there's lots of risks as well. It's very difficult to value a company that doesn't have too much history and is not profitable. So there's lots of risk, but it seems like the company is growing a ton. So it could be a huge investment with you 5 or 10x. So I'm really excited to see how the company develops in the near future. I rank their free cash flow as 1 out of 10, their revenue 7 out of 10, and the ratio is 2 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.